Hello, everyone. Today on the Final Bar, we're joined by Chris Ciovacco from Ciovacco Capital in Atlanta. Happy Fed Day. We'll talk about the anticipation leading up to the Fed announcement, essentially the quiet period, and then the sudden reaction after comments from Jerome Powell and the report from the two-day meeting of the Fed governors. We'll look at the impact to stocks, to bonds, to commodities, the dollar, everywhere. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets. If you're looking for a message today, I think we finally got a message from the market. I always talk about the message that the markets provide, but the last couple of days have been, the message has been hold, please hold, is what essentially we've gotten, right? With lighter volume, with the market overall relatively sideways. And while there are certainly stocks breaking out and some stocks breaking down, overall, it was sort of a net, middle of the road sort of period. Today, we certainly had a reaction to comments from the Fed chairman this afternoon. You saw the big move in most asset classes. In the end, we sort of settled into the S&P down around 0.5%, which is not a huge climactic down move. It sort of traded down earlier. That's all obviously, I think the challenge for the Fed, the committee is that, anything that is, any comment that is remotely hinting at anything happening in the near future that is a little less dovish than they've been is going to cause the market to do this. And I think that is the risk that has been building up. And I think little moments like today where they can soften the blow of the Fed's policy becoming more hawkish over time is probably the best they can do. But it's certainly going to create some challenging moments. We have great guests on the show, as always. I'm excited to talk with Chris Ciovacco. He always brings long-term charts that make me think about, big picture ideas. And today, I don't think you'll be disappointed by his discussion. Tomorrow, on the 17th, we have Leslie Juflas from Trading Live Online here in the Seattle area. On Friday, we'll be taking the show off, and StockCharts will be closed for the Juneteenth holiday. Coming up next week on June 23rd, we have Tony Dwyer from Canaccord Genuity. Tony also, by the way, is going to be part of our mid-year special discussion charting the second half. We had a lot of fun last year, having some great discussions with some top technical analysts and strategists. Excited to have Tony Dwyer, Gina Martin-Adams from Bloomberg. I will be talking with John Murphy. We have Martin Pring coming up. It's going to be a lot of fun and some great perspectives for the second half of the year. That's coming up soon, actually, in about a month or so. We're getting everything set up for that. Let's continue on with our market recap. Today, really, it's been about the Fed, and I would argue most of this week has been about it. It's been about the lighter, sort of preparation time, the calm before the storm. And then today, you sort of hear what's happening. You can see the market reaction. So very quickly, if you look at the dashboard, your dashboard page, each look at the two-day preview charts, you can see the movement that happened as a result. The Fed, in the afternoon, 2 p.m., the report comes out, the minutes from the meeting, 2:30, you have Powell's press conference. You can see the movement that happened very quickly. And that initial reaction was, and a little later, by the way, we have a full segment called Don't Fight the Fed, where we'll dig a little more detail into what the implications are of what all was discussed. But, in general, you saw stocks sell off very quickly. And the reason for stocks to sell off, for bonds to break down, rates to pop up, for precious metals to come down was, this discussion about inflation continuing to be transitory, which certainly put a weight on gold, but also this implication that at some point the Fed is going to have to be less accommodative and start doing some things. And again, all that they really did in the minutes were remove a little bit of language that implied that they would do whatever, whenever. And although they still reinforced all of that and said they will continue to do all, it was basically indicating this light at the end of the tunnel getting closer. And to be honest, that's all it's going to take, given this market, given the overextended environment, given how far most things have run. That's all it's going to take to push some things around very quickly. So let's look a little more at the short-term movements today. We'll focus on the longer-term implications of the Fed a little later in today's show. The S&P down about 0.5%. Mid caps about the same, a little bit more. Small caps noticeably were actually flat for the day. They were just positive there at the end, but we're not able to hold it up. Financials are a big weight in small caps, much more than the large cap index, and financials for most of the day were actually toward the top there, especially in the afternoon. But consumer discretionary in the end won out on the upside. The VIX just around 18 now, and the Nasdaq, by the way, is down about 1/3%. At other asset classes, plenty of movement in the fixed income markets with 10-year yields coming up to around 157, and that's after being around 149, 148, 149 earlier in the day. After the comments, after the minutes, you saw them jump up very, very quickly with this implication that inflation is not a concern, that rates are just fine, and no need to change policy anytime soon. Precious metals certainly felt the pain. You can see how gold and silver came off pretty quickly. Gold was a little bit up for the day at 2 p.m. Eastern, but came off, closed down around 1.7%. And, as we'll talk about later, this is all about the short-term reaction. And then given the days and weeks ahead are when the market actually digests what came out today. Today was sort of the initial reaction. No real surprises, I think, based on the types of comments that we have. Cryptocurrencies essentially all in the red today. Bitcoin continues to roll over, coming off from around 40,000 earlier in the day here, selling off down about 4% from where we were yesterday at this time. In terms of sectors, real quickly, and then we'll focus on a chart of the S&P here for a moment. Consumer discretionary, the only of the 11 S&P sectors up on the day. We're still kind of digesting the final ticks here, so could be a little bit of movement, but overall looks to be about flat for the day. Financials as well. The two of those were the clear leaders. Energy number 3, and as we've talked about in recent shows, many of the top 10 ranked stocks in our Scooter rankings, which is a measure of trend on a number of different timeframes, all aggregated into a Scooter ranking, a percentile ranking. Many of the top 10 stocks are in the energy sector, including the new number 1 stock, which is Marathon Oil. You have MRO, Devon Energy, FANG. What else is in here? I think that's it actually for energy, as I'm glancing through tickers very quickly and trying to remember sectors for all of these. I think that's about it actually. You have a number of healthcare on there now. You got Capital One, you have Nucor, which is a materials name. It's a whole mix of things up there, some biotech as well. But overall, on the downside, utilities actually felt the most weight to the downside, down about 1.5% today. A lot of the cyclical sectors, including materials and industrials, weakening today and underperforming. Let's look at a chart of the S&P here. So, it's interesting if the Fed's comments today did nothing else, it further validated this trend line that we've been talking about for a while. So thank you, Jerome Powell, for confirming my trend line with your decisions and comments today. If we take a line from the October low, connect that to the early March low, that lines up very well with the mid-May lows. And with today's low, it's the way I was taught looking at trend lines, this goes back to Edwards and McGee, which is sort of the Bible for trend lines and chart patterns. I mean, that was really the seminal work on traditional technical analysis and looking at price patterns. They confirm that the more and more that the price touches a trend line, the more it confirms that. The way I've always thought of it is a visual representation of the pace of the trend. And if we get really far away from that trend line that tells you things are accelerating and things are changing, if we break the trend line that tells you that is no longer an appropriate representation of the trend in the chart that you're showing. So further validation occurs when you continue to test that trend line. We've now tested 4 times coming off of the October low of last year. And what that does, every time we confirm that by testing that line, and if we would bounce off of it through the remainder of the week, it just further validates the importance of it. And if and when a break occurs, which it certainly could, tomorrow into Friday, you could see a rotation below that trend line. And I think that would be the first level. That's the first line in the sand indicating there may be a potential trend change. I think given the strength that we've had, given the strength in a lot of individual charts, especially some of the mega cap names, I would want some further validation. The 50-day moving average is not too far below that. It's around 41.77 today. Below there, I think the real ultimate test would be, can we remain above 40.50 on any pullback? That's about a 5+% pullback from where we're at right now, I would say, eyeballing the levels. Which is about right. You hold a 5% pullback, that would be in line with previous pullbacks we've had during this bull phase over the last 6 or 7 months. Breaking down through 40-50 would indicate, definitely a change of character and more of a distributive phase than we've seen in quite a while. It's worth noting, by the way, the fact that as the market has gone higher, and this week, no different, every time we make new highs, we seem to do it on lower momentum. That is not an overall encouraging sign. And you saw a similar pattern back here in January and February. Now, granted, you had a 5.7% pullback. In the end, you resolved higher, broke to new highs, and the momentum divergence dissipated. You had new highs going into late March, early April, which confirmed a run to new highs, which is where we're at now. See a similar pattern, and again, that is not a 100% topping signal or anything like that, but it indicates the characteristics that are similar to previous tops, which means I want to look to see if we hold support on pullbacks. And that's why there's some of those levels that we mentioned. The trend line that we tested today, the 50-day moving average, and then 40-50, I think are so key to pay attention to. A lot of other movements in the market today, and a lot of rallies in some groups, things like cruise lines, NCLH, and CCL. That if you've missed some of those, I'd certainly encourage you to pay attention to. Also, Enphase, which has been a chart that really just got disrupted, really gapped lower and started to trade down. Now really starting to work again, making new highs and new lows. So as always, check out the market movers and focus on some of the actionable trends. We need to take a quick break here. We'll come back with my guest, Chris Ciovacco. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us, as always, every weekday after the close as we break down some of the key patterns and movements during the day using the power of stock charts. As a reminder, we would love to hear from you, particularly questions that come up in your own process of analyzing the markets, analyzing your charts. You can send us questions via email, thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below any of our YouTube videos. We'll capture all those questions. Hope to answer one of your questions in our next mailbag segment. Also, as a reminder, go to StockChartsTV.com. Use your email, set up a free account. You can start watching all of our great content on that website. Also, on all of our mobile applications, all of your mobile applications, featuring some of our fantastic hosts, wonderful guests like Chris Ciovacco and others, all captured on demand that you can take with you and watch anytime you like. Go to StockChartsTV.com or search on the app stores for StockCharts TV on demand. I want to welcome on my guest joining us on the show once again today, Chris Ciovacco. Chris is the founder of Ciovacco Capital in Atlanta. Chris always comes on with long-term charts that make me think and put movements into context. Chris, welcome back to the show.
Happy to be here, David.
So I really appreciate on a day like today where we have the Fed coming out, there's plenty of uncertainty, sort of this quiet period, and then you get the big reaction. Help us put this into proper context. When you're looking at asset allocation, you're looking at stocks versus bonds. We have your first chart. What are you seeing?
Well, there's a lot here. And I think the real message for stock chart users is a lot of people will tell you that you just want to use price. And there is a lot of truth to that. But indicators can help you see things that are sometimes difficult to see or quantify with price. And this is a great example. Upper right-hand corner of the screen, we've got the ratio, and that's Bollinger Bands. And if you just look at price, you can see that's consolidation, that's indecisiveness. But if you go to the bottom, it shows you the Bollinger Band width. And that's giving you some way to quantify how indecisive. When it gets low like that, that's telling you you've got an indecisive market. That reading is extremely rare. In fact, we never got as low where Dave's cursor is, the lowest point in the entire move from the 2009 low. And between the 2003 low and the high in the S&P 500 in October of 2007, it occurred one time. So what that's telling us is in the short run, this is a squeeze. And the fact that that ratio in the upper right-hand corner of the screen closed below the lower Bollinger Band, that's not particularly good if you're a bull for the stock market and you would like to see this ratio right itself quickly. ADX is basically telling us the same thing. Black ADX is what I like to call it, below both green and red, tells you you've got a sleepy trend. And especially when black ADX will move 4 points up below red and green, that tells you a new trend could be starting. So what does this mean? This is telling us that we should be open to a big move in this ratio, either up or down. The way that it sits today, it's leaning down. That would be the bad news in the short term. If we go to the longer term chart, this may be somewhat of the good news. We're looking at a similar ratio, this time using mutual funds. This is again the S&P 500 relative to long-term treasury bonds. Similar to the other chart, it's a lot like SPYTLT. You can get all of this from price, but the indicators help confirm it and might help you see it. If you look on the left side where the ratio is, we have a long-term period of consolidation in the smaller rectangle on the left side of the screen, 1991, 1995 area. TSI below that is telling you something. Then we get a breakout, and look how long the ratio goes up before it peaks. That's an extended market. It's extended from the base. And that's exactly what TSI below and ADX are telling you. TSI is telling you we've been trending for a long, long time when we get up to the top there in 2000. And ADX, black ADX over red and green, is an extended market. When ADX turns down, it's telling you you should be paying closer attention, in this case, in really the weeks or months ahead. Contrast the look of us near the box in 1996 and 2000 with the present day. So price-wise, you can make an argument that, well, we're probably going to fail in the same manner that we did before. But you have to keep in mind, we've been inside of a consolidation box for more than 20 years. And that box is somewhat similar to the box on the left side of the screen between 1991 and 1995. And if you look at our momentum and how extended the market is, I think you can make an argument longer term, this ratio has a great chance to hold this breakout this time and move to the upside. Because look at ADX. It's just the opposite of where it was going into the peak.com peak in 2000. Black ADX is below green and red, a sleepy trend. And if you look at TSI, it's just turning up now and has somewhat of a similar profile that it did back in 1991 to 1995 before the ratio broke out of the box on the left side of the screen. So moral of the story is the indicators help you see or identify some things that you can probably identify with price alone. They help us quantify it. Right now, it's telling us we should be open to a potential big move one way or another. Right now, it's leaning bearish for stocks. We shouldn't get too bearish because this chart's telling us that it could resolve to the upside eventually. Maybe we have to go back and retest the dotted trend line that's at the top of that box in the ratio in the upper right-hand corner. That's one possibility.
Chris, it's so helpful. And I love how you're combining sort of the long-term view with the short-term view. You can see the potential weakness on the short-term chart, but then the long-term view sort of illustrating, obviously potential for there to be further outperformance of stocks over bonds. We only have about 30 seconds left, Chris, but I'd love to ask, given what you're showing here and potential for short-term weakness in stocks relative to bonds, when you're looking out a couple months and thinking between now and in the fall, how would you look to be positioned? Do you get defensive, sort of planning on some weakness? And if so, where would you be looking for opportunities? How would you think about that?
I think if you're fortunate enough to have gains, and that would be where we are. Lately, we've not really seen a whole lot that's told us to get defensive, and we've not really seen a whole lot that's telling us to get more offensive, and that may be about to change. We have a lot of charts. If you look at a lot of SPY, TLT type charts, ratio charts versus your positions, a lot of them are about to break or already have broken the long-term trend line from the March 2000 lows. So net bottom line, I would have a contingency plan in place to protect profits. That's an if-then contingency plan. If the if never comes, no problem. You're okay, but it's a good idea to have those plans. And if we pull back, you don't want to get too bearish. You always want to look at the longer term charts and see what the message is there as well.
Chris, it's so good to have you on as always. Really appreciate you sharing your thoughts and answering my questions. Be well, stay safe. We'll talk to you again soon.
Fantastic. I appreciate the opportunity. Keep up the great work with the show.
Thanks so much, Chris. That's Chris Ciovacco. Chris is the founder of Ciovacco Capital in Atlanta. By the way, I don't know, and I didn't have a chance to get too much into it, but the TSI indicator is one that I don't actually use very often. I don't know if I've ever used it on the show. It's the True Strength Index, and I tend to think of it very similar to MACD, similar to PPO. It has a kind of a similar calculation, and I think you can use it in very similar ways. If you're not familiar with that indicator, by the way, look at the chart school portion of StockCharts, search for TSI, and you'll get some details on that indicator and what it means. It's interesting. I always think about what sort of environment people are not prepared for. And I think Chris's first chart that shows the SPY versus the TLT, the SPY versus TLT, and you see how it has had, obviously stocks have been outperforming for so long, but if you look recently, they've really been sort of a wash between the two. And I think that sort of change, I know for me, I'm just so programmed based on recent history to assume stocks are obviously outperforming bonds because they have been for so long. That changes. I think that's a especially in the short term, I think that would catch people off guard potentially. Great comments there from Chris Ciovacco. Let's continue on. Our next segment is called Don't Fight the Fed. Today, Fed Day, and really digesting. I think many of us still digesting the comments. It's funny. I'm taken back. I took one course in communications in college, and I feel like we did not look at Fed chairman at the time that I remember in the class. We looked at a lot of, communications and speeches and thinking about it. Talk about someone who's speaking that everyone is like focusing with a fine-tooth comb on every word that comes out and just the manner in which something's being said. It's a fascinating case study in interpersonal communication. Having said that, let's think about some of the implications of what we heard today and what that means, particularly relative to the charts. When we talk about the Fed decisions, Fed policy, tend to think of it as a big picture on how it would potentially impact different parts of the market. We'll talk a little bit here with the time we have on equities. We'll look at the chart of gold. We'll look at interest rates and just how they reacted, and then we'll look at some of the financial stocks, because I think in terms of, with a lot of things, you can make assumptions about what might happen to different stocks, different groups, depending on Fed policy. Financials are one that tend to be directly implicated or directly affected by those, because a lot of the changes, obviously, the Fed can put into place would first be felt by the banks, because that's really their area. That's where there would actually be be lending money and borrowing money that is going to be impacted by Fed decisions. So let's look at each of those one by one and talk about it. So as I mentioned earlier in the market recap, the S&P obviously coming off a bit on the comments. And if you look at the short-term chart, we can look at, boy, we don't look at a lot of short-term charts on the show, do we? I really try not to, but on a day like today, it's really about the quick reaction. So if you look at what happened during the day here, the initial sell-off was after the minutes came off. And all you can do there is look at the language in the Fed minutes and see what was changed. And a little bit of language was changed right at the beginning, which essentially sort of downplayed a little bit of the impact, the negative impact of the coronavirus pandemic and the reopening. It sort of implied that we were, sort of closer to the end than we had been in the last meeting, and as a result, people sort of, then draw that natural conclusion. That means the Fed at some point soon is going to have to take some action. I don't know how you wouldn't think that at this point. I feel like that should be priced into the market in terms of our expectations, but certainly if you look at what asset prices have done, it certainly seems like there is a fire hose of liquidity that is not changing at any point in the future, and any implication that that's going to stop is met with some sort of decline. Then you have Powell's press conference, and then soon after, around 2:45 Eastern, the market starts to rally and come back and basically make up most of the losses that happened around 2 p.m. In the end, sold off a little bit going into the close. So overall, that implication that at some point down the road, the Fed is going to have to do something to to sort of change the policy on their purchase of treasuries and affect the markets in some way, certainly seeming more likely than it did before today's press conference. Let's look at some of the other asset classes. The next one that comes to mind is gold. If you watch the conference, and I try not to watch too much of those, to be honest with you, and it goes back to my point is to analyze charts, and the less I know about what Powell is saying, to be honest with you, the less likely it is to bias my analysis of the charts. And a good analyst, what hopefully I'm able to do is understand what the Fed is doing and think about it, but also analyze the charts in an unbiased way. But again, the more you watch and listen to those things, the more that those narratives can fit into your analysis. And it's something I try to be wary of as much as possible. So, what happened today with gold? Well, gold certainly came off along with other metals, other precious metals. And, the chart of gold certainly has had a pretty decent run. I mean, the move in gold has been impressive. Gold became overbought. We're looking at the GLD here. You can see that it came out of that overbought range there at the beginning of June, gap lower, really hasn't regained that high. And so while today was a bit of a sell-off for sure, this is within the context of a short-term decline. And the chart of gold in the last 2 months looks like a lot of the financial stocks, to be honest, had good runs, became overbought, and now have rolled over a little bit. And the question is this an actionable pullback, resetting the stage, reloading for the next move higher? And I would argue it is. I think with gold and precious metals, this idea that inflation is transitory, and he laid out the reasons why that might be the case. That's interesting, but overall, I feel like we're going to continue to see inflation concerns over time. I think this was a reaction to that, but the chart of gold will tell us that we're right at the 50-day moving average, which is why this is going to be a really key chart to watch through the remainder of this week. Testing the 50-day moving average, the RSI right at 40, which in a bull market phase is about where you'd expect that to bottom out. So is this setting the stage for a roll a little higher? We only have a minute left, but the last thing I want to talk about was just Treasury yields. Obviously, bonds selling off, yields coming up through the course of the afternoon in reaction to the message that we heard. Overall, I feel like this further validates this range that we've talked about. Interest rates, the 10-year yield here has been in a range from around 150 and really 145 is where we hit earlier this week or from last week, and the upper side 175. Does this mean we remain within that range? I'm struck by Chris Ciovacco's chart looking at the SPY TLT, the narrowing Bollinger Bands, which is essentially meaning there was a volatile period and now it's been less volatile. And I think with 10-year yields, we've seen the same thing. You had a big run higher, and now it's sort of in a consolidation phase. The question is, do we break out to the upside or break down to the downside? I think that's another chart to watch as well. So obviously, a lot of short-term reaction to the Fed, and what I love about the benefit of charts is we can look past just today's movements, focus on the long-term trends and how they're evolving. We need to wrap the show today and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is a chart of the S&P. I usually don't feature the S&P 500 in the 3 and 3. However, I think it's just a really actionable moment. Testing this trend line support, I think, is key. One of two things happens by the end of this week. Either we further validate this trend line, which we have already done, or we break through the trend line. This is, I don't know if it's the top, but at least it's a top as we see further corrective pressures in stocks. But I will certainly be looking at this trend line support that we are currently at, as well as the 50-day moving average is not too far below current levels. Chart number 2 is Disney, and this is a chart that stands out to me, just an illustration of a stock that had been making new highs just a couple months ago. At the end of the first quarter, we're making new all-time highs. Here toward the end of the second quarter, we're in an established downtrend of lower highs and lower lows. We're below a declining 50-day moving average, and I'm thinking of that chart, the breadth chart, looking at the percent of stocks above their 50-day. There are a lot of stocks like Disney, which were above their 50-day back here in February to March, as the S&P is making new highs. They're now below their 50-day moving average, and that speaks to internal weakness. That speaks to a series of stocks across a series of sectors that have broken down already. Finally, for stocks like KeyCorp and other regional banks, I think if you look at a trend line from the March 2020 low, you can connect that here with the September low and the October low and early November low. We are just above that trend line. And as we test the 50-day moving average, break a little below it, although KeyCorp recovered nicely today and bounced off on the rates going higher. I'll be looking at that trend line for a further sell-off. Folks, that is our show. Thanks so much for Chris Ciovacco from Ciovacco Capital joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.